So good to have you with us after quite a bit, isn't it? So much of gyrations in the market, especially even in a huge mature market like Wall Street. How does all this pan out? Do the markets take a very long time to heal after such huge whipsawing moves?
Morning, Lata. Good to be here again. My sense is that one should not try and analyze the global situation too much at this point in time. I've seen that last couple of days, everybody's taken a pot shot at trying to analyze what the global situation is like. But believe me, nobody knows what's going to happen from here on. So you should not, break your head trying to analyze China. China is a black box, as we all know, and it's not Lehman Brothers. So like people are saying, this is not 2008. Sure, it is not, but it could be worse than 2008 because then one single company brought the world to its knees. We are talking about such a giant economy which is in serious trouble. My sense is that this is a problem that you cannot wrap your head around, particularly sitting in India so easily. So you shouldn't spend too much effort trying to do that. If you are an investor who's a long-term investor and you want to buy this dip, I think it's better to focus on individual companies which you have a much better chance of analyzing accurately than trying to figure out the global problem. I think the global problem is of a magnitude and of a nature that will only unravel itself or present itself over the next few days and weeks. Right now we are in a bit of a flux. Generally buying in a flux is not such a great idea. So I know a lot of brokerages are coming out with their lists after the big fall and saying we should buy this and buy that. But I would sit on my money right now and just see how things pan out because we are in a zone of confusion and uncertainty globally. Nobody in the world quite knows how this cookie is going to crumble. And at times of such uncertainty, whether you're bullish or bearish, I think it's best to keep any kind of predisposition aside and sit on your money and see how things pan out over the next few weeks.
Okay. Udyan, hi, good morning. So when you say sit on money, is it not putting in fresh money or even, redeeming some of the stocks in which perhaps you've made a good amount of money in the last 1 year?
Sonia, it's difficult to give or hand out any kind of trading advice, because this is very unlike the kind of corrections that we've seen earlier in the year. We have seen corrections of 300, 400, 500 points on the Nifty, and they have been for reasons which could be analyzed. Suddenly we are presented with a beast which can be a game changer. None of us know whether it will be, but this could just end up being a 76, 7800 Nifty correction, which on hindsight could be a buying opportunity. The markets might spend a lot of time digesting or licking its wounds, but then over a period of time it will work its way upwards once again, following that uptrend which has been in place for the last couple of years. Or this could be the start of something more ominous. Right now what you're hearing from people is basically predisposition. The bullish will tell you, you must buy this dip, nothing has changed, India is in a great macro position. The bears will say, this is the big breakdown which the world was waiting for the last 3 years, and all hell is going to break loose from here on. But that is not any kind of insight into the problem. That is basically whether you're bullish or bearish, and you're laying out your foresight or prediction based on that. I think that's not a very accurate kind of hypothesis to go with. So my submission is, and it's not a very helpful one, I will say at this point in time, is that at the first sign of the first cut, you should not rush out to implement a strategy. Give it a little bit of time. This market is not going to run away. That much is clear. We are not going to 9100 day after tomorrow. I think that all of us understand. So when there is no rush, why do you want to come out and buy and catch the last 4%? I think you need to just calm down a little bit, not trade every day, not try and catch every short covering bounce or short every rally. This might be slightly bigger than what we've got used to over the last 6 or 9 months. I hope it's a transient phase. So far we have no evidence that the bull market has turned, but I think it would be prudent to give it a few days to figure out how big this problem is really.
Okay, so would you say that you don't buy only in this period any stocks at all, or do you think that if opportunities are there in stocks which you have studied, which you have analyzed, for instance in pharma, it would be a good idea to deploy some money there?
That's an excellent question, Lata, and that's the one should be focusing on. In that, the answer to the first part of your question may well be yes, that there is turmoil, a lot of prices have corrected significantly. if you're confident about some of the stories that you've analyzed closely, there is no harm in going out and buying in small doses. The problem is in the second part of your question. Have stock prices corrected enough? And in that, I would say that the important thing that investors should keep in mind right now is to look at stock prices not just in reference to their recent highs, because that's the mistake people end up making after a fall of this magnitude. They will say this stock was 800 and it's suddenly below 700 and then therefore I must buy it. You must ask yourself another question. Is there considerable uncertainty in the global space right now? The answer to that may well be yes. So if you are buying something, would you want a little bit of safety under your belt in terms of valuations before you go out and buy, or just buy because the stock price has corrected 10% from what was a fairly lofty valuation level? You mentioned pharmaceuticals. I think there are some excellent bets out there. But the recent rally in pharmaceuticals before the crash happened had actually taken many of these pharma stocks to very high valuation levels. So they may have corrected 10%, but they have corrected from 28 P multiple to 25, 26 P multiple, and that kind of a valuation multiple in the context of the kind of global uncertainty we sit on may be a very expensive price to pay. So I would say by all means go out and buy businesses that you want to buy or have wanted to buy, but at this point don't make the mistake of paying very aggressive valuations, because the context or the platform in which you are operating might have shifted somewhat from what it was a couple of weeks back.
In a phase like this, is it better to stay with the large caps or look to buy the large caps and avoid mid caps, Udayan? Because, you know, generally in the past we've seen at turbulent times like this, the mid caps tend to be a very treacherous space.
You know, you have to stick with quality, Sonia, at this point in time. Large cap or mid cap, you cannot be going out and buying dangerous stocks at all. And in that, I think it's pretty clear that the set of stocks that you should be avoiding at this point in time would be the ones which are falling knives, which we all know, the commodity-linked kind of companies, the poor balance sheet companies, and that worries me the most, Sonia, at this point in time, because you know, if the world goes into a difficult spell, more than whether the Nifty is going to 7,300 or 7,500, there was an opportunity that in a good period, a lot of the balance sheets would get repaired. But if global capital gets scarce now, as does not seem very unlikely over the next few months, I think you will find that a lot of stress will float up to the surface. And the kind of trade that people were talking about in Jan-Feb this year, which is to go out and buy stressed balance sheets because they will repair, and you will get much better bang for the buck for some of these stressed companies. I think they'll find it very difficult to fix their balance sheets now, and that in itself will convert itself into a lot of stress into the public and in some cases private sector banking universe as well. So I think that's one fallout of a difficult liquidity situation globally which might be upon us, that I think poor balance sheet companies, they go out of the fancy trade completely and people start focusing once again on good balance sheets and high quality companies. I fully expect the market to become narrower from here on. You're seeing signs of that already. The mid caps and small caps are not doing well, and that would be the first place where people would want to check out. But as I said, this is a market in a complete flux at this point in time, so things could remain very choppy and you could get very sharp bounce backs. But there is no simple trade in hand right now.
Okay, let's move out of trades and look at earnings for a bit. Then, are you getting a sense after you looked at the second quarter numbers, at least of some consumer companies, that there is a healing process underway in the economy, and therefore at least an earnings worry or worry of earnings downgrades cascading is out of the way?
You know, this quarter was mixed, Lata. There were some positive signs to latch on to. There were some negative signs as well. So I don't know whether it was such a conclusive quarter in terms of a turnaround in terms of earnings. Also, remember that the Nifty has a fair component of export earnings as well. And that picture now becomes quite unclear with the way the world is shaping up. I don't mean to sound alarmist for 1 minute, but if the export basket continues to do badly going forward, and I think IT might be on the watch list, I wouldn't be rushing out to buy IT stocks right now at all, then you might have a very bipolar kind of an earnings picture even going forward, and on balance the Nifty or the Sensex earnings might still not be recovering at the pace at which we think it may be recovering. But my point is a little different. I think what we are doing right now is to say India stands out in a relative light, and that is absolutely correct. The ministers or the finance ministers are saying the same thing, the RBI governor is saying the same thing, and brokers are saying the same thing, that, you know, India is in a better position. It certainly is. But if this becomes a problem of the magnitude that previous global disastrous situations in the market have turned out to be, then these relative trades are not very important. I think what you then begin to see is a big shift or a tectonic shift in asset class preference. Then it does not matter whether one country or one equity market has better fundamentals than the other. My fear is not that India is in a worse situation compared to Brazil or Russia or China or even the United States. It's whether global investors might take a dim view of global growth prospects and want to realign asset classes completely. And we can see some beginning or starting signs of that with the way the US bond market is moving. If and when that happens, then one country is never singled out, and India will fall regardless of very good fundamentals relatively in line with other equity markets. I hope it does not come to that, because relative outperformance of India falling less than other markets is no consolation for the crowd that we are speaking to, which is the domestic investor. He cares only about absolute performance, and absolute performance may be hampered in a difficult global scenario. Again, to repeat, we are not there yet. This is no global bear market, at least yet. However, you need to be vigilant, because if it shapes up to be that, then I refuse to buy that India will be singled out and India will continue to rise in the face of a falling global equity scenario. History tells us that never happens, and it's completely wishful on the part of brokers to think that will happen this time around.
So you'll keep your cash in money market funds, fixed income money?
You know, at the current time, you know, as they say, if you run away, you live to fight another day. But there are no points for being brave in the stock market. It's a difficult situation. It may get uglier. It may get worse. We don't know. I think if you are sure that the market is not going to run away from you 15–20% from here suddenly and you would have missed the bus, then I think it's prudent to say, let me miss out on the next rally of 3–4%, but I would rather be safe than sorry, because it's hard-earned money at the end of the day. Let the money earn 8–9% for the time being. Let the global picture get a little clearer. If I have to buy at this point in time, let me buy high quality at reasonable prices and choose only from a few baskets. You know, the blue chip housing finance, blue chip private bank, absolutely clean balance sheet infrastructure company, and a few top-notch pharmaceutical stocks. I think your buying basket is now limited to a handful of stocks and handful of sectors in the midst of this global turbulence. Within that, if you want to cherry pick, you certainly can, but I won't be going out all guns blazing before the situation clears out a little bit globally.
All right, then thank you very much for joining us with your thoughts this morning, and we do hope you'll join us soon enough, and we will be talking about a healing in the market and not these continued gyrations.